It takes us to our talk of the tape. What that so-called big, beautiful bill on the Hill means for the markets and those deficit dangers. Let's ask Adam Parker. He's Trivariate's founder and CEO, and he's here at Post 9. It's good to see you. Welcome back. Is it all about rates? Is that what you're watching more than anything right now, or what?
You know, I just got back from 3 days of a bunch of meetings, and I feel like every institutional investor I talk to is confused. It's like, on the one hand, flows are positive. There's nothing that's going to kind of break the momentum. People are afraid not to own, equities. And on the other hand, they're worried about Walmart CFO saying prices are going up 8% in June, and they know there's some impact from the earnings. And so people are very, I said, afraid to not participate, but talking very, very negatively. So it's like a very defensive rhetoric, but people aren't positioned there yet. I feel like there's a lot of tension in the investment world right now.
I'm glad you used the word tension, right?
Yeah.
Because it plays into where I wanted to go next. You talk about you talk to investors. You talk to big institutional investors, hedge fund managers, and that's who the audience that you're speaking about.
Right.
Most leaning negative, what's going to be happening in the months ahead. You talk to the CEOs, like I did and heard from this past week at our CEO summit.
Right.
They're not negative, not nearly as negative as the investor class is. Sure, they see the soft data like everybody else, but until it starts to actually show up in their numbers, they're not really buying it. To a person, they're reasonably optimistic. You listen to what Marriott CEO Tony Capuano told me, and then we racked you on the other side. Let's play that.
I think the reality is this. Our business thrives in times of stability and high consumer confidence. Neither of those have been in ample supply in recent months. However, the fact that you've seen this fundamental shift towards prioritizing travel and experience, we just did Q1 earnings. We beat on almost every metric, and we would have beat a lot stronger if not for March. January and February, we came out very strong. Then you saw a little bit of shock to consumer confidence in March.
All right, shock to confidence. We all seen the numbers, but it hasn't shown up in the numbers. What if it doesn't?
If it doesn't, we'll definitely go higher. I think your tee up of like rates is the only thing that can stop it. It's probably right. I think there's definitely people talking about that. But at the end of the day, there's a narrative where, input costs are down, whether it's oil, metals, or logistics. Dollar weakening helps. Maybe we get some AI-proof cases. Top 100 companies generally have pricing power. And so maybe earnings estimates are too high, but they always come down, and maybe we're okay. And there's a probability you sign to that basket of things happening, and okay. And then
you're talking about it almost as if it's some far-fetched idea. Am I misreading your tone?
No, 30, 40, 50%. It could happen. I think it's real, but I think there's also a probability that you got a little pull forward in demand, that companies raise pricing even though it wasn't on tariffs, and Walmart raises pricing from 50 to 54, 58, 8% is a real number. And if that's the best they can do with all the power they have over their suppliers, we could see some weakness after that. So I think people are torn about, how to anticipate kind of the July earnings season, the October guidance. I think there's also some people who are concerned about whether they really want the Fed to cut. There was a narrative, they'll cut, and that's good. But I think other people are saying, well, if they're cutting, it's because things really got visibly worse. And I don't know if we wanted to give it, pause might be the best scenario. And so there's definitely kind of perception about rates, perception about growth tension. My view is I've got to find some offense. I think the offense that people like are stocks that are down from 52-week highs. Like what ripped in January, sold off hard, and maybe if this keeps going, I should get there.